if you don't buy now, and rates, I don't think they're going up, but people that don't buy now think that rates are going to 10%. That's why they're not buying. So let's work off that assumption.
Right.
So if rates are going to 10% because no one's buying, these people, I'm just talking to you people out there. That's all I'm talking. I don't know how many of these people are, but these are the TikTokers, the YouTubers, the Twitters, you 10%ers. If you think rates are going to 10% and supply and demand is where it's at, that means that prices are not going to dip. Because even at 10%, there's not enough supply, right? So if there's not enough supply, all you're doing is raising your cost basis. So the only person you're screwing is yourself.
Yeah.
What's the 5 Ps? Do you remember it?
Proper preparation prevents poor performance.
There you go. It doesn't matter how much money we get. If we don't close, it's no money, right? So no close is no money. I'm everything that I am because of my dad's death. And I wouldn't be as successful without his death. Welcome to the next episode of The Jason Theory. And having worked with a lot of first-time home buyers over the last couple of years, more than usual, it's been interesting to me in terms of how novice people are with mortgages, which only makes sense because they're first-time buyers. So I thought it was really important for me to have a top-end mortgage broker in the city of Chicago come talk to us and hit on a couple things to outline what we want to hit on. And hopefully we get to it, because sometimes we get sidetracked with really cool stuff and don't get to it. But what we want to get to are what you need to do to start out. Ye who has the gold makes the rules, and these are the rules that you're going to get. So these are the things you have to abide by. Creative financing programs you probably didn't know you have. I want to talk about some neighborhood loans and stuff like that, and how they want to get money into certain places. The environment that we're in, obviously all the rate hikes, and how to play that to our advantage. And Hani's going to talk to us about different things that you can do and why it's a great time now. And why, if you want to wait to buy because of rates, what that's going to do to you in terms of affordability. And then we'll talk about a couple other things.
Yeah, no.
But I want to kind of hit on those things first. Hani, just tell us a little bit about yourself and how you kick so much ass.
Oh, thanks, man. I appreciate you having me on.
Oh, my pleasure. We've known each other for a while, so go on.
Jason's a great guy. But I work with Guaranteed Rate, one of the top loan originators there and in the country. I mean, it's all about making sure you have a solid process in place, right? And that you're providing the consumer with the most amount of benefit, right?
Okay, yeah.
With respects to homeowners, what they're looking for, pre-approvals, the process, one big thing that I see is that consumers are not getting themselves in front of a mortgage lender soon enough, right?
Yeah.
They're waiting where they're going, they're looking for a home, and then all of a sudden they find a home they love and they want to place an offer. And although sometimes it does play out where it's fine, it just works out, a lot of the consumers just not well prepared on the things that they need to do. For example, how much money they needed for a down payment, what their credit looks like, and their options in terms of what the housing monthly payment will look like as the rates go up, what that monthly housing payment will look like, and all that stuff.
I think the last one you hit on is the most important. What you said is they don't know their options. And if I could really, being an agent and dealing with new buyers, old buyers, there's so many options out there that if you've got, that's why we're both here, is to provide options for people. You provide broker options, I provide housing options, right? Loan options, housing options. If you don't know all these options and all these, without a lack of a better word, tricks underneath your sleeves, there are so many ways to skin a cat. And there's so many ways to finance a house. Totally. And everyone has a different situation. And I don't think people know their situation until they go and say, Hani, pull my credit. This is what I make. Okay, X, Y, and Z, Don Juan, you can afford X, Y, and Z, but you want this. Let's see, how can we do that, right? Do we want to do this with a different product? Do we want to do this with maybe a parent co-signing or someone else? There's so many different ways to go, and people don't know that. And I think how much easier my job is when they come to a showing and they have just a chest full of weapons of different loans that they know that they can do.
Absolutely. And it makes them a more educated buyer too. It makes your life easier. It doesn't create any surprises for both the buyers, sellers, all parties. And it just more or less puts the client in a position where they're less feeling very emotionally distraught or like nervous because they know what they're getting themselves into.
Yeah, I mean, it's right. For most people, it's the largest purchase they'll ever make in their life.
Okay.
And that purchase can't occur without you, right? You have to have money to buy something.
You're right.
You have to have a tradable good. So that's the money. And how are you going to get that money? And what's the best way to be leveraged? What's the best situation for you? And everybody's different.
Totally.
Some people are like, hey, I can put 3.5% down. I'm going to keep my cash. Some person's like, I got to put, my dad put 20% down. I'm putting 20% down. Everyone's different, and you're going to provide those options. And you may say, hey, listen, man, I know you want to do this because you've said it to me and you've said it to other people, but this may be the better route to go. And let me explain why.
Absolutely. One thing that you're seeing too is, like, for example, consumers are all pushed on 20% down, right? But if you look at their debt, it's ridiculous how high it is, right? And they're paying 20%, 15% on these credit card debt, right?
Ooh, this is a good one. Let's go into this.
Absolutely no sense, right?
Yes.
You're stuck on the idea of avoiding a mortgage insurance premium that's going to cost you $125, $150, depending on the purchase price, right? But yet you're racking up all this debt on credit card debt, paying at 15 or 20% interest rates. It doesn't make sense. When you could attack that credit card interest, right? Or I'm sorry, the credit card debt, minimize the amount of expenses you're paying monthly as a result of a lower interest rate, right? And then taking that, it'll increase your credit score. It'll then put you in a position where you're getting a much better interest rate as a result of a better credit score. And yeah, you can then slowly start attacking the monthly.
Okay, so like, I understand everything you just said, and it was a lot, and I loved it. So you just say yes, I'm gonna break it down.
For sure.
So especially with the Fed raising rates, that variable rate is your credit cards, direct reflection. So that's prime plus whatever Visa wants to stick it to you. And that also depends,
Yeah, no, I'm with you.
That also depends on your credit score. The higher your credit score is, the less risk you are of not paying your bill, which lowers like when I get APRs, they're low. I am not a low, but other people may be high.
Right.
So what Hani's saying is, what's PMI? What's the percentage? Is there a ratio? Like, is there?
It's a lot of different factors. Is it a condo, single family home? What your credit score is?
So a snapshot, 10%, 5%,
a little less, about 1.5%.
1.5%.
Yeah.
Okay. So what we're saying is that you don't want to put 20% down, and you've got let's say you got $100,000 worth of debt, student debt, whatever debt.
Right.
You're a party. You've been charging up the Amex. You were in Miami too many times, Vegas. You got $100,000 of party debt, and that debt's costing you 25%. That's a lot of money. And that's probably where we are now in APR for someone that's not great. Okay, so you're going to buy a house, and instead of putting 20% down, we're going to put 10% down. That rate is, let's say, 6.5 or 7%. Why would you put 20% down on 7% debt when you have $100,000 outlaid at 25%? That means, everyone, that you're getting screwed every month on 18% on that spread. It's insane. It's not smart money. And that's what Hani is telling you. Pay the small PMI, pay down your big debt. Paying down your big debt lifts your credit rating. As your credit rating lifts up, your APR and all your credit cards will refinance down because you're lower credit risk. And on top of it, you have a home, and you also can extend. You're going to start making equity on your house, which is another thing we're not going to get into, but 100%. Sometimes I always think, why would you want to put down the most amount of money? It makes no sense because there's better ways to make money. Unless you literally have no route to make money and you have no debt.
And your housing, your income is fixed to an extent where it'll never increase or change.
Yeah.
And you just don't know how to get
like our parents.
Right.
So, all right, that's great. I love that.
For sure.
We'll snip that. It's gonna be a story. I love it. Okay.
Cool. For sure.
Okay. So that is the things that you need to do before you buy a house, is knowing all these options and getting comfortable. Because once you're comfortable with the finances, you can walk into a house and go, I love this house and we can afford it. And maybe we can't do that 20. Maybe we do 5. Maybe we do 10.
Yeah.
Or maybe we buy that house that needs $10,000 or $20,000 worth of work. We're not going to put down 20%, and we're going to build equity.
Yeah.
Okay, they've come to you, they've gotten their pre-approval. We got to talk about some don'ts. Some money don'ts while they're pre-approved looking for a house.
Right. I mean, the most common ones. Don't obviously run up credit card debt. Don't go buy a new house, boat, or car. Right. And if you are, talk to me about it. Right. Because clearing those things out, knowing before, is a good indication of what you're getting yourself into. Right. And potentially going under contract and not being approved. Right. So that's one thing. Down payment funds, obviously don't, loan it out to somebody and then that other person pays you back in cash or something like that.
Are there any seasoned laws anymore when you're borrowing money, when it's being
60
gifted?
days.
60 days. So there's...
Right. So the funds have to be in your account
so deposited in 60 days.
For 60 days without us having to look at it and determine whether or not we have to know where the source of where it came from.
And then how about let's just use this example. A parent is going to lend their child some money. Yeah. They do the 60 days. It's been in their account. Will they want to know when it went into the parent's account? Are they going to trace those funds from the parents?
So if it's 60 days, we don't care who it came from.
Okay.
Right?
That's what I want to make sure. Okay.
From a perspective of if it came from a parent, it doesn't matter how long it's been in there because we just get a gift fund. We explain, parents are people that you can actually give or donors that are acceptable. And you don't have to worry about it.
Would it be better in terms of building up one's credit?
Right.
Is it better for the parent to co-sign and then put the money in, or the child or whoever to buy it and be gifted the money and be on title alone? Is there any difference in terms of like building wealth or building their credit?
Yeah, for sure. I mean, from a perspective of, whether it's better for the, child or the buyer that doesn't have their parent on the loan, it doesn't really make a difference. If they can qualify, they can qualify, right? But now if you're in a situation where they don't qualify and you add the parent, it's great, right? But otherwise, you want to minimize the risk and obviously the people that are involved by keeping it solely to that person that's buying.
Okay. Okay, cool.
If you come about a position where you need to add a cosigner and it's something where you just got out of college, you haven't been making the funds, but you're a commission job and you're going to be making a ton more money, it's an option, right? And then 12 months later, 6 months later, refinance the loan and get that parent off.
Now, self-employed, what are the overall general rules on how long you need to be employed at a certain job, how you show those funds? This is a question I get all the time now.
Yeah, it's very common because a lot of people went self-employed,
yes,
right? Especially working remote and whatnot.
Yeah.
So it's a little tricky, right? Because if you've been in the industry, right, for let's say 3 or 4 years, right?
So you sell vacuums for 4 years.
Right. And then all of a sudden you're a high commission, right, job or salary, and then all of a sudden you start your own company and you're doing the exact same thing.
So you're still in the vacuum business, but you're doing your own thing.
You're S corp now, right? You can run off of a 12-month history, right?
Of your past, or it has to be of your S corp.
Of your S corp.
Okay, so right. It has to be your new business. So if I'm with Hoover Vacuums for 2 years and I leave Hoover and I open up Stratton Vacuums, I need 12 months at Stratton.
Right. Okay. 1 year tax return.
Okay.
Right? I would then at that point be able to use that.
Okay.
But typically, if it's something new that you're just getting into, it's typically a 24-month.
So it's 1 year tax return or 12 months of being with Stratton?
1 year tax return.
Okay, so I could start the business in October and be fine.
Right.
Okay.
Right. But then you would need that year's tax return for the following year.
Oh, so it's a full 12 calendar month. Okay. Exactly. It's a calendar
January
month. Okay.
1st
I got you.
December 31st.
I got you. And then how about, I had a client that ran into this. How about changing titles and jobs within the same company? That's been a problem for me in the past. I don't know if it's still a problem.
Right.
I've had people change jobs mid-loan and get more money, but since the title changed, it just blew everything up.
Yeah, I'm not sure who handled that or what happened, but typically, as long as a title change is fine, right? Making more money is fine. Where it gets a little tricky is, for example, you're a $200,000 salary employee, right? And then now you are going to be the head of sales, and you're commission based, right? But you're only a $50,000 salary, but your targeted price or your targeted income is going to be $300,000. Well, the unfortunate issue is that $250,000 of that money is going to be commission based, right?
Yeah, so it's not guaranteed.
It's not guaranteed. Plus, you need a history of it in order to use that as qualifying income.
Yep.
Right.
That's what happened to my friend.
Yeah.
Like the broker was like, "Oh, it's more job, take it," but he didn't ask what's the split.
Yeah.
So she made more, but the guaranteed was less.
And that's the
it was a disaster.
So mortgage companies want to look at a proven track record, right?
Yeah.
How stable it is and how likely it is going to continue, right? And if you can, explain that well enough to a mortgage lender or to a mortgage company, and it makes sense, it's typically something that we can accept.
Okay.
Right?
Okay. Just a slight pivot on the same multi-unit, non-commercial. So 1 unit to 3 units. 4 units. I'm sorry, more than 4.
Okay.
No, I know that because of the FHA. What are you seeing in changes there? Everything status quo? Are there anything that's kind of getting a little funky? I push a lot of multi-units, you know that.
All right.
Owner-occupied multi-units is something that I love. Something that I asked you about, which has been a wrench in the last couple of weeks with the rising rates, is going to be this sustainability. So for people that are looking to be owner-occ, FHA, let's just lightly hit on this sustainability rule that FHA has, which is actually making it effing impossible to buy a multi-unit with 3.5% down. Off the record, I mean, I've been looking at the numbers. You got to have like a 12 cap. I don't know where you're getting that. Anyways,
it's something that's derived from the FHA directly, Federal Housing.
Yeah, I know. Yeah, so right. hit on that.
There's something called the sustainability factor, right? That you basically have to. FHA has their own ratio where the housing price is going to be X, the loan amount is going to be X, and that monthly payment and the rents coming in have to be X, right? And if it's too little, it's not going to pass its sustainability test, right? And if it's not passing the sustainability test, then FHA has an issue with it, right? What you're seeing as interest rates go up is the cost of that housing payment then begin to increase. And although it's something where you're going to go in and you're going to fix the home a little and you're going to increase rents, FHA is not taking that into consideration, right? And that's, I would say, 7 or 6 out of every 10 people that buy a home intend on increasing rents or doing some type of...
Yeah, and that's why you buy it, to increase the intrinsic value of the house explodes, and that's where you make money on a multi-unit.
Not many people are looking to park their money in the multi-unit just to park it.
Via FHA, it doesn't make sense.
Right, absolutely not.
So then, how do we sidestep this? As a 2-unit and 3-unit buyer who wants to be owner-occupied and not at 20%, what are some options out there for people, be it low track?
All right. So with a 2-unit, there are a couple different options. Minimum down payment, you can go as low as like 10%. You can even go as low as 5%, right? Depending on where that property is located.
Okay.
Right? So there's something called a Home Ready loan option, Home Possible through Freddie Mac. And depending where your income is and where that actual home is, it's a high likelihood that you can buy it as low as 5% down.
Yeah. And I got that website and I was looking at, the nice thing about that is that a lot of the areas that I think a young buyer would want to buy in and invest in are in those areas. They're safe areas. They just haven't like boomed, like let's say a Wicker or an Avondale, but they're there.
Yeah. No.
There are spots that are west of Kimball, the 3000s west, up and down,
right,
that are actually great hoods that have that.
That comes into play.
Yeah.
Typically on
it's tough.
Loan, it is tough, right? And it depends where you're looking at, right? And what the opportunity is for that area.
Yeah. All right, so we've hit on a couple of those things. Let's also hit on getting towards closing.
Right.
What the week before closing has been always me writing long emails on what's going down. So we're a title state, which means that we have lawyers and we have title, right? So we're a lawyer state, which means title handles that and lawyer handles all that other stuff. Everyone's always asking, when do I get my figures? And I always tell somebody, as a buyer, we have to sit and wait for the seller to hand us figures. So let's just go over the last week. When it comes to you on the last week before closing, can you just briefly go over, okay, as a buyer, you're going to get this on this day. We have to wait for this, and this, and this.
Right. So what we'll do is about a
real
week,
basic.
Yeah, no. A week before closing, we'll send out the estimated figures, taking in consideration the information that we didn't know when we initially disclosed the loan, right? So when you first get the package, things are updated like the title fees, right? That we didn't know, that now we overestimated, that now we actually know what those title fees are. What we don't know are a lot of factors, HOA fees, what the credit is, tax credits, attorney fees, all that stuff. So what we'll do is we'll send out an updated closing disclosure. We'll basically buff it with an extra like $1,500, $2,500 to the consumer depending on the purchase price, and we'll tell them you can wire this. Any additional funds that you send to the title company, you'll get a cashier's check or a wire back that same day for that amount, or for that additional amount. Typically 24 to 48 hours before closing, we'll have that updated number. We're seeing it now go towards the 24-hour mark. If not the same day sometimes.
I always tell people it's not our fault, because you have to get numbers from the title company, and the title company has to get numbers from the seller. So if the seller's attorney doesn't provide those numbers, it is what it is. But you can always ballpark it. I don't understand why people have to have it by the penny. It doesn't make fucking sense to me.
Because the way we're programmed is we know everything way in advance, right? We're a now world, right? And I kind of understand them to that degree, right? Like, well, I'm buying it now. Like, why don't I know the number? But it's just something you just got to get used to. Like, hey, it's a transaction involving numerous parties, and that the likelihood of knowing everything up in the future is just it's going to happen. And it's not possible.
It's not possible.
Yeah.
I mean. Yeah, so that, I'm always like, listen, what you put, like people are like, well, what do I bring? I go, well, you know what you put down is earnest money. You have a ballpark figure on this stuff, add a little bit more, like cut you a check at closing. Take that money and go
Easiest
party.
way to do it.
Go to the bar with your new keys. Let's talk about the environment we're in now. Obviously, the Fed is trying to ease down inflation.
Yes.
The two biggest issues they have, because I read all the minutes, is labor. They're upset on how hot the labor market is. Okay. Don't pay people to stay at home. It's like
for too long.
Yeah. I mean, that kind of like contradicts what you're trying to do. And number two is housing. Yeah. So that's what they're trying to stem down. Gas, corn, lumber, all that is out of bed. It's way low. So these are two things. So they're raising rates. By raising rates, we're actually raising the cost of what it costs to hold a place every month. The number one question that I get all the time is, why buy a house now? So the people that are buying a house now did not buy a house the last 2 years when rates were under 3. So this is what we're dealing with first off, okay? So they didn't buy a house when it was under 3 because they didn't want to pay over list. They couldn't act quick enough. They didn't come to a place fully qualified. So no one's waiting until Monday when there's 17 offers because you don't have a pre-approval. That was the biggest problem.
Crazy.
Number 3 was they didn't want to deal with multiple offers. So they don't buy with this historical low rates. Rates go up because everything goes up and down. That's how it is. And rates were not going to stay sub 3%. Rates are back to where they were historically at 6%. Actually, historically would probably be like over 10, but they're at 6% now. Why buy now and not wait a couple months?
Yeah, so I think the biggest problem that we have right now is that people really need to understand the supply, right? How much supply is in the market, right? Okay. And how the supply is not really meeting the demand. You've had a lot of people put buying a home on hold, but it's not because of they're worried they can't find a house, or more or less because they want to kind of slow it down. We got to edit that, by the way.
Yes.
The reason primarily why people are not buying right now is because they're not well educated on what's going on, and they expect that home prices are going to dip. And I don't think that's going to happen. I think they're going to actually hold. And the reason why I think they're going to hold is because of the demand and because of the supply. People with low rates right now that are currently in their home are not incentivized to sell, so they're staying in them. The new home build is not as much as the demand is kind of there for. So you're in a situation where I don't think home prices are going to fall, rates are going to go up, and it's just going to be a situation where people are going to wish that they locked in at the 6% versus the 7.5%, right? From my understanding and what I've heard from the Fed and all the research I've done is that we're at the top end of where they're going to increase interest rates. There's one thing that the Fed is taking in terms of the approach, that they are kind of overshooting, right, with the hikes, to be in a situation where 6 months from now they get the data that they're in a position where they're kind of controlling the inflation pretty strongly, and they could always do a rate cut. It's always easier to rate cut than basically still tackle on the inflationary issues. But I do think that we'll see it for the rest of the year, probably Q1. And then I think things will stabilize. Because remember this, right? So the housing, the GDP accounts for 30% of the housing and housing associated services.
Yeah, I talked about that on a TikTok last month.
That's a lot.
That's a lot.
Right? So they know what they're doing, and they know if they do it too long, how it could impact the market.
Yeah.
Right?
I think the lack of demand is the lack of supply is, and I mean this in the clearest sense of the word, is the major ignorance that's out there.
Yeah.
So
what do you mean by that?
Okay. And this year alone, so I can only speak of Chicago. I always say that. This is Chicago. No matter where you listen to this, Chicago. It gets different in secondary markets. In Vegas, in Florida, it gets different. In Chicago, the August numbers just came out. We're down 35% in inventory year over year. So we're down 35% in inventory. Contracts are only down 17%, which means you're losing even more supply. Okay? Because you would need contracts to be down more. This is basic math.
Yeah, no.
You would need contracts to be down 40 or 50%. Because if supply is down 35 and contracts are down 17, that means more of the supply is being eaten. Now, let me explain that even further. In Lincoln Park, last month, the average day that a house was on the market was 18 days. I'm sorry, 32 days. 32 days. Overall, last month, the Chicago market as a totality went to 18 days.
Wow.
It was the shortest span ever. And pricing in Chicago hit all-time highs. So to take Lincoln Park, because it's fresh in my head, you have supply down 35%, contracts writings are down 17%, and prices up 4.8%.
How are home prices going to drop?
How can prices drop?
Yeah.
Because on a supply and demand chart, if you're pulling supply to the left because it's shrinking, even though you're bringing demand down, it doesn't matter because the price stays stable. So that leads me to why you said, if you don't buy now, and rates, I don't think they're going up, but people that don't buy now think that rates are going to 10%. That's why they're not buying. So let's work off that assumption.
Right.
So if rates are going to 10% because no one's buying, these people, I'm just talking to you people out there. That's all I'm talking. I don't know how many of these people are. But these are the TikTokers, the YouTubers, the Twitters. You 10%ers. If you think rates are going to 10% and supply and demand is where it's at, that means that prices are not going to dip. Because even at 10%, there's not enough supply, right? So if there's not enough supply, all you're doing is raising your cost basis. So the only person you're screwing is yourself.
Yeah.
Because the overall math is every percentage point, you lose about 10% of buying power. That's rough math. Don't hold me to it, but it's close. So if you could afford $100,000 million house right now, I'm using a base number, $1 million house right now, and we go from 6 to 10, you then can afford only a $600,000 house. but the lack of supply is so hard. It's so soft. It's so light that there's enough people at the 10% market to take that supply. That's why pricing hasn't changed. So all you're doing is waiting for higher rates. Now, let's say you're like, oh, I'm going to wait till higher rates and then wait till rates drop.
That's why they didn't buy the last 2 years.
That's why they didn't buy the last 2 years.
Yeah.
So you're just sitting on the sidelines the whole time
and
not buying equity.
Buying equity,
that's it, tax savings.
Yeah.
So the whole time you're just stuck in this conundrum because you don't want to buy when it's too aggressive and you don't want to buy when the market's right to buy. It just makes no sense to me when I listen to these people. I'm like, well, then when are you going to buy?
Yeah.
It's never a bad time.
And it's hard to educate.
It is.
Because, a lot of people too, I feel like they are kind of worried about like the 2008 crash, right?
That's a credit crunch. That's a credit. I mean, that's a whole other. That's something different.
We're not going to get too deep in it, but it's something real, right?
Yeah.
People think of it, right? And I think that it's important to understand for all the viewers, right, is that was a situation where there was mortgage fraud. There was appraisers that were doing fraudulent activity.
Well, there was systemic. I mean, the issues were way beyond that.
But it was
you took down economic foundation companies that have been around for 150 years.
It's crazy. But the big picture is that it's a different ball game now. It's regulated for the right reasons, right?
Yeah.
And we're in a really healthy lending environment, I think.
Yeah.
Honestly.
The amount of cash buyers, 20% buyers, none of this has ever been higher. So it's different. And I do agree with you too. Them raising rates, and I want to hit on that again too. Them raising rates, and this is why I said next year, forget it. Next year's gonna be worse. Them raising rates is just gonna tighten supply. Because why am I gonna move?
Right.
I just refinanced at 2.5%. I'm paying $2,000 for $1 million house. I'm gonna fucking move. I don't need to.
They're not. Absolutely not.
No one's gonna move. And where rents are, they're like, okay, I'll move. I'm gonna rent my house and I'm gonna cash flow. Like what they're doing is gonna create even a more supply side shortage, and the demand is still gonna be there. So when the rates drop, you think price? This is my 2 cents.
I'm very.
And I've been right for about 22 years.
I guess you felt right.
And what I think is gonna happen is you're going to see even harder price appreciation next year, and affordability is going to be even worse. And you can walk down the streets of Chicago and 6 to 7 people own where they live. You walk down the streets in New York and LA and ask people if they own or rent, and they all rent. They can't afford to own, and it's coming to Chicago.
Yeah.
And you either buy now or be a renter for life.
Yeah.
This is why people that are a lot smarter than us, all these people are BlackRock, all these people, that's why they're buying so many homes.
Absolutely.
20% of the market last year was investors. And I mean big investors, not me, little dude. I'm talking big dudes.
Yeah. I see it.
Yeah. And I just don't understand. Like, don't be nervous. Get in. And you could get the house you want now. It's less competitive. I mean, I'm not going to lie to you. It's less competitive now, which is great. There's still no supply, but there's less demand because people gave up. It's seasonal. Get in now and just refinance. I mean, the back month red, so that's the back months of the interest rates. They're showing rate cuts already in third and fourth quarter of next year. Just refi.
Yeah. I think honestly, number one, get educated. Know what you're dealing with. Understand it. Don't let it don't formulate these ideas without having any really good facts behind it.
Yeah.
And I think that once you go through that cycle of understanding what it looks like if you were to buy, at what rate, at what purchase price, it'll all make sense, and then you'll make a good decision.
Yeah. And then let's hit on this last thing. Someone comes up to you, well, everything we've just talked about right now.
Right.
And like, listen, at 6%, I can put 20% down or 10%, whatever it is, at 6%. I can't really get into the house that I want to get into. What are some creative ways that we can get the seller to incentivize the buyer? We've talked about some rate buy downs. I'm never a huge proponent of ARMs.
Right.
I think it's the smartest thing to do because they are going to bring rates down, and I'm always kind of against them. But you do a 5 or 7 year ARM, things are going to come in.
Yeah.
And you can secure the house that you love right now, get a deal on it, and then refi.
Yeah, I mean, a great option if you, for example, know you're moving in 5 to 7 years because you're going to have children and you want to move to the suburbs or move to a different home in the city, right? It makes no sense to lock yourself in a 30-year fix, pay that premium for 7 years, right? You're better off getting into a mortgage product where you'll take a discounted rate, you'll be locked in for the first 7 years, it's amortized over a 30-year period, and you capitalize off of a lower monthly holding cost, right?
Yep.
Another idea to that is that essentially, a year and a half from now or 2 years when rates start really crashing down, hopefully, of course, but they will definitely be coming down, that you'll capitalize off of refinancing. And maybe at that point you can deem whether or not you'll be in the home for another 30 years or 7 years or 10 years, and you can refinance into a different mortgage product at a lower rate.
Yeah. And if you don't have 10%, if you don't have 20% down,
right,
when you're doing that refinance, you may have that equity right now and knock out that PMI.
Especially if you're going to do some renovations, small renovations, do it your own, whatever you're doing to the home, increasing value, you're right. There's a high likelihood.
Can we hit on that? This is the last point I want to hit on because I hit on it all the time in terms of equity and building wealth in real estate. Can you just hit on the fact that we put 10% down and the steps, what you just said in terms of getting rid of the PMI, and that you don't have to put another 10% down because there's appreciation.
Right. That's something really big that a lot of people look past. But instead of worrying about the mortgage insurance when you're basically buying the home because you're putting 10% versus the 20%, but you go in the home over a course of a year and a half, 2 years, whatever it is, you start fixing up the home. You do little things here and there that increases value, and then the biggest factor is the appreciation, right? As we're dealing with this supply issue, the home values are going up. Right.
Yep.
So when you come to that time frame, whether it's a year and a half from now, 2 years from now, when rates have dropped, and you're looking to refinance, now you're in a position where that 10% was gained as a result of you making the monthly payments for the past year and a half, the appreciation of the home stuff that you did to it, and the appreciation of the market value.
So what you would call up Hani and say, Hani, listen, I've been just looking around. I talked to Jason. He thinks the value's here. Can we do an appraisal? Because I think I have the other 10%.
Right. First off, we'll start it off based off of the rate, right? See if there's savings there.
Yeah, see if it makes sense.
For sure.
100%.
And then based off of that, we'll then look at, we have a bunch of, in-house services that we basically deem or can see what the actual value of the home is. A lot of times we won't even need an appraisal, right?
Nuts.
And then in a position where we're telling the client, hey, you don't need an appraisal. We're getting your mortgage insurance removed. It's a no-brainer for them. Right?
Yes.
It puts them at nothing but a net tangible benefit.
I love it. Last question.
Talk to me.
Borrowing money, HELOC, from your house to do investments, to do upgrades, to pay down high credit cards, this, that. What is, as an owner occupied, what is the, what are the debt limits that they want these days? If you have $100,000 of equity, what are they going to let you pull out?
Well, you can go up to 95%, right?
Oh, wow.
So let's say you owe $70,000 on your home. You can basically take out another $25,000, right?
Okay.
In a home equity line of credit. In terms of using that money, if it's for another investment, obviously you can use it for that. You can use it for whatever you want. Credit card debt is a big thing, right? Don't let the money or the equity sit in your home when you have all this credit card debt.
Yeah.
Minimize your monthly payments on that. Don't worry about the 6 or 6.5% interest rate.
Well, it's all about the spread, and the HELOC's tax deductible.
Right. A lot of people, for some reason, just love all this equity in their home, but have all this other debt that when you look at the numbers, don't worry about the thought of having equity when you have all this other debt and it's costing you 10 times more.
Yeah.
Just illogical.
It's mathematically does not make sense. There's so many things that people think is a safe way to live, and it doesn't make sense.
Yeah, you're right. The best thing is to not have it at all, but unfortunate situation.
But debt makes money. That's
Fortunately, it does.
That's why banks loan out money.
Yeah.
All right. So give us some contact information if people want to get a hold of you. They want to talk about the rates. They may want to talk about the process. Give us your deets.
Yeah, no, for sure. If you're ever looking to get any information, coaching, whatever I can do to help, you can call me. My number is 312-375-1993. My email is hani@rate.com, and I'm more than happy to lend advice or give any help I can.
And Hani just let me know before we got on this that they have now 1 day clear to close.
Yeah.
That's crazy.
You know, we're always...
I've seen Hani close a condo in 5 days, but I've 1 day clear to close.
We're in a competitive market.
Yeah.
Although rates are up, we're always looking at how we can kind of better ourselves and put the consumer in a better position where when they're putting an offer in, they look like the best, and they are the best. And by going in saying, hey, we only need a 7-day mortgage contingency and I could clear to close the loan in a day, that puts us, other than, of course, title, right?
Yeah.
That puts them in a really good position. They're almost basically waiving the mortgage contingency.
Yeah, they basically are.
And that looks great for a seller that needs to sell their current home and they're looking to put an offer on a new home, or, you know, they just want to get rid of that property as quickly as possible.
And I think too, like, and this will close on this, if you are, like, when I call Hani or I give Hani a client, the approvals I get, they're full approvals. They're not these, you know, oh, I haven't done this. If you're going to get approval, do everything, because I'm going to tell you right now, agents I look at the approval and I look at what has been verified, what has been done. And that's really, really important, especially in luxury, and especially with, you know, luxury market are all pretty much agents that know what's going on. It's really important.
You know, we're a really big technology driven company. And one thing that we really push on is getting a client pre-approved or requesting docs and waiting on them. It could be a little hassle, right? And it's a hassle to the consumer, and it's a waste of time almost. Well, I shouldn't say it's a time killer. So if we have like technology that'll allow us to automatically pull it within seconds, why not take advantage of that, right?
Yeah.
And pre-approve the client, and we know their whole profile right away.
That's what you need.
And that's what we're doing. Thanks, man.
Thank you so much. Everybody subscribe. We'll be on YouTube, podcast is Spotify, and man, every other asset, Audible, this. Any questions, or you want to get a hold of me to then get a hold of Hani because you're too scared to call Hani directly, I'll do that too. Enjoy yourselves, and we'll see you all in 2 weeks. Thanks so much.